marks about 6 months of us talking to each other on screens, which obviously no one is a fan of. This has been one of the most trying years in history in a lot of ways. Sadly, I have many friends who were very sick from Corona, and some families of close friends who had grievous losses. It's really touched me personally, and a lot of people that we know, the firm knows, and really our whole economy, right? I mean, we're at depression era, unemployment, countless small businesses are having issues where they're fighting for their corporate lives. We've seen more market cycles this year than we really have seen in the last 10 years. I mean, we saw the end of a 10-year bull market, a massive sell-off in March, a new bear market, the end of that bear market being the quickest end to a bear market in history. And now we're back at what looks like one of the most overvalued equity markets in history, even after the declines of the last week. Historically, many investors have gone towards trend following strategies, which are usually called either medium term or long term trend following strategies, as a source of crisis alpha and portfolio protection. Typhon, we have always avoided trend following. I've never run a trend following strategy. I've never done a long short equity strategy. We instead believe in what we call tactical trading strategies, which are quantitative in nature, fundamental commodities, futures market structure, things of that nature that have uncorrelated return drivers that don't depend on picking tops and bottoms in equity markets, but rather can adapt to fast changing markets and hopefully provide portfolio protection. So we started these conferences back in 2018 as that equity market was getting long in the tooth. It was Harry Pagel's idea for us to start these. You're going to see a little bit of him later working with some of the managers as a moderator. Here we have today 8 managers. Most of them have been to many, if not all, of our previous tactical trading investor forums. And all of them did what they said they were going to do and made money for their clients in the sell-off in March, and are looking, to the future always, right? It's in this industry, a lot of people like to fight the last war, so to speak, but markets are always changing. Economic circumstances are always changing, so you really need to be forward-looking. So we're going to hear from today 8 different managers, how they're looking at it. We have a series of panels. So everybody speaking today is an allocator or portfolio manager in the space. So you're going to be hearing straight from the horse's mouth, from people pulling the trigger in some of the most historically challenging and volatile markets of all time. So I think it's going to be a great educational program, especially for people who are new to the space. But also, given that we're in this 6-month interminable lockdown, cases are spiking again in Europe. The U.S. has just crossed over 200,000 Corona related deaths. We do think it's important that we don't just focus on keeping your portfolios up in down equity markets, but the mental health, the physical health component really is important for everybody to listen to. So after our educational trading-based program, you're going to hear from 2 very good friends of mine. Our keynote speaker, Missy Perdue, she's a legend in this industry, has been in this industry a long time, has done a lot of work to combat human trafficking, but is also the recent author of the book How to Be Up in Down Times, which I think is extremely time sensitive. So she's going to talk about strategies, how to stay positive, how to stay happy, and how to cope with everything that's been going around us. And along those lines, we're going to follow that up. Instead of a happy hour, everybody watches each other drink on video. We're going to do a high intensity interval training class. Obviously, this is optional, but For anybody who want to get a taste of one of the things that's really been great for me during this lockdown, we've got Jake Thomas, who is a renowned fitness teacher, bodybuilder. He's going to work us through about a half-hour workout class at the end of the day. And with that, we're going to get on to our first panel. We want to start right here on 9:25 because Roger is swift. He's a very punctual gentleman. We're glad he could join us. And let me hand it over to Roger Hilty from LGT. Many of you know him. He is going to be the discussion leader and lead us through the introductions of our first panel, which is opportunities in Europe. Roger, take it away.
Thank you very much, James, and appreciate the opportunity to be on this panel together with Ren Bitar, Fixed Income Portfolio Manager at Invesco, and with Nuno Mendes. You touched on a number of challenges in your introduction speech. There are also opportunities in Europe. That's the name of our first panel discussion, Opportunities in Europe. My name is Roger Hilty. I'm partner at LGT Capital Partners. We are an alternative investment specialist with 60 billion in assets under management, and I co-head our managed selection investment team. Pleasure to be here. I would like to kick it off with Ren for a brief introduction of herself, and then with Nuno, and then we start with the talking points about opportunities in Europe.
Sure, thank you, Roger. So just a little bit about myself. I'm a portfolio manager on the macro side, so discretionary. Don't look too much at quantitative strategies, mostly focusing on fixed income. Happy to cover any questions today, but market-wise, I will be focusing on credit markets.
Hi, Roger. First of all, thanks for inviting me to be here. I was the CIO of Time Family Office for 5 years until last December. Now I'm looking for another opportunity. And I was a banker for 12 years before, working with derivatives in all asset classes. So I have a broad perspective in macro themes. I'm a top-down guy, let's say.
Thank you both, Ren and Nuno. I would like to start with the first topic. We have seen strong rally in risk assets, especially led by technology-driven US indices. If you look at an S&P and NASDAQ and so forth. If you look back even a decade, we have seen that European equity markets substantially underperformed, for example, US markets. If you look at the MSCI Europe as an example, we have seen underperformance versus the S&P of more than 55% in the last decade. And European stocks are at a historical 100-year relative price low versus US peers. If you look at the COVID-19 situation and how the US and Europe have been handling this, obviously we have seen that Europe has been ahead of the US in terms of recovering from COVID-19. The situation is quite fragile. We have seen some newer cases and higher numbers of infection rates, especially in France and Spain most recently, but still handling it relatively well in Europe and also with far less stimulus than US. What's your opinion in terms of whether there are specific buying opportunities in Europe, or do you think that this post-holiday COVID-19 situation and infection rate increases in Europe could reverse this trend? I'd like to start with the opinion of Ren.
Sure, thank you. As James and you said, COVID infection rates have reaccelerated here, and many countries are already dealing with the second wave, including the UK. So you can say the trend is reversing. In any case, Europe will see more COVID outbreaks this winter. This is expected. What is not really priced in is a repeat of the full-on national lockdowns we had in March. Are there buying opportunities? And from where I sit, the positive technicals in European fixed income created by light positioning going into this crisis, and also by the tremendous amount of policy support, have actually been holding everything together. We've seen corporate borrowing costs fall from decade highs in March back to historic lows today. Despite weakening fundamentals, we initially saw significant outflows from high yield credit, but that's all coming back now. So this decoupling from fundamentals was due to the hunt for yield theme being back in play in the fixed income markets, since the ECB effectively put a cap on spreads with its PEP program. Also, although the inflows into credit have slowed recently, the levels of cash are still elevated, judging from demand for new issues. So all in all, technicals are still looking supportive in European fixed income. So yes, there are still opportunities. But saying that, the recent stability is not normal, given all the near-term event risks from Brexit, US elections and fiscal policy, COVID waves, etc., which makes me and many other investors very cautious at this point. We have seen a mini sell-off this week on Monday, and I think we can expect further vulnerability in the weeks ahead.
Thank you, Ren. Now over to you, Nono. Any opportunities you see in European SM markets?
First, just a touch on the macro picture and COVID. So we've obviously seen a rise in the number of cases in Europe. That's also linked to a huge increase in the number of testing, which shouldn't be ignored. But if we look at hospitalizations and number of deaths, they are still quite low and not comparable to the lows we've seen, the highs we've seen in March or April. Of course, there might be a lag, but I think the health system and the society are much better prepared now to deal with the virus, and we will end up to learn to live with the virus itself, and that I think gives a less pessimistic background going forward regarding Europe. Also, we can't ignore, and as Rain was saying, it's not priced in and it's not probable a full lockdown as we've seen in March or April. So policymakers will do everything to avoid full lockdowns. We'll probably have, to wear masks and curfews, and there'll be the limited numbers as we're seeing of people who can get together. But it's still a less bad picture in terms of economic activity we're seeing now going forward. Also, we can't ignore the stimulus package of 750 billion. Of course, when we talk about all the trillions the Fed is injecting in the US market, and the CARES Act, the first stimulus, the government, the US administration got going, and the second they're trying to agree, it seems like not a big number, but I think it's a game changer in terms of the commitment from Germany and France and all the countries for the euro to remain together. So I think, at least as far as the eye can see, there is no doubt the euro will stay together. And then in itself, for me, represents opportunities. The so-called convergence trades will be back and are already being back, either in fixed income. Rain knows a lot more about that than me, but even in the equity markets or in real estate markets, I definitely see opportunities. We can't ignore the stimulus. Again, just Germany, for many years, investors were saying Germany doesn't spend and is obsessed with having a budget surplus. They were saving it, they were saying, for a rainy day. Now they acknowledge the rainy day has come. So the stimulus plan is like 130 billion, 3.4% of GDP. France, 100 billion, 4.1% of GDP. A lot of that aimed towards green projects and new infrastructure, upgrading buildings and energy efficiency. And I think that's responding directly to your question, brings opportunity on the construction and manufacturing sector, as far as I can see. Also, speaking about the convergence, so-called convergence trades, I also like hard assets as protection to inflation, especially in the periphery. I think real estate in countries like Italy, Spain, and Portugal definitely look interesting right now.
Thanks for that. I agree also, you touched on it in terms of COVID-19 and the European situation, what we see in the press. Infections gone up, however, more younger people affected this time. And also, as you said, hospitalization rates coming down and then also mortality rate coming down. So we agree with that assessment that there is, I would say, more limited risk for a second and broad-based hard lockdown. And it feels like Europeans really follow the US approach, basically living with the virus, that we can minimize this economic damage and not just slow the economic recovery with these precautious measures, but not stopping it. We also touched on technology briefly before. Oftentimes also European assets or European indices are, let's say, in parentheses, considered as old economy, which actually, interesting enough, has changed. There's quite a lot of technology components within the European indices. If you look at, for example, the MSCI Europe is no longer overweight banks, which might be a perception people looking at Europe. So we have currently 6% weighting in banks, coming down from 14% in 2010. We have healthcare at 16% of the index. And if you look at technology, specifically, you spoke about Germany, the MSCI Germany is technology with the heaviest weight of 14%, not cars, not autos, manufacturers. Interesting enough, so 14% in technology is also Europe. The index constituents and sector weightings have actually changed quite a bit. The second talking point when we speak about opportunities in Europe, if you go over to the US Fed as the leading central bank has also made quite a shift recently in their strategy with interest rate cuts, lower rates for longer, and also temporarily accepting inflation measures or rising inflation. So that led to some currency market movements. We've seen a strengthening of the euro apart from the last 2, 3, 4 trading days. What's your opinion, going back again to Ren, to start on this, what's your opinion on European currency, the euro strength, and how that might weigh in on investment opportunities across Europe?
Sure. So the euro has been one of the main beneficiaries of this US dollar downtrend, as it came at a time when there was a perception that Europe was doing a better job managing the COVID crisis, and when we had a huge amount of policy measures which sent a strong signal of solidarity within Europe. Now, from a European perspective, we heard some mixed signals from the ECB this month. A lot of the comments were on the dovish side, but they didn't seem overly concerned about the currency's strength. And this lack of urgency to act against it and willingness to let it run a little further, while remaining dovish, is broadly speaking a positive for European assets, I think, in general.
Nuno, would you like to add to?
Yeah, I think euro has benefited from, again, the commitment and the stimulus plan, and also we've seen again Germany extending the furlough scheme until end of 2021, France for another 2 years, but the ECB many times have said the problem is not so much the level, the problem is the speed at which the euro sometimes appreciates. So so far it's not been disorderly, as they sometimes say. I think actually European markets and the equity markets are now, as we've seen, better prepared to deal with a stronger euro. Actually, it's very interesting, and until just the sell-off mentioned last Monday, we were seeing the European market outperforming, which is quite rare, as you've mentioned, Roger, for the last 5 or 10 years. So the Euro stocks was basically trading flat for 1 year, and we were seeing this S&P and the Nasdaq sell-off. So maybe using the so-called four most dangerous words in finance, as they say, maybe this time is different. Maybe Europe will start to outperform from now on. Obviously, that involves taking a view on technology versus, let's say, other more like traditional real economy sectors, and also probably taking a view on growth versus value. Specifically regarding euro dollar, I would be, I don't think the euro has much further to run now. We see from the COT report, non-commercial speculators, let's say they're fully along the euro. I think they reached all-time highs recently. So I think euro has made at least a short-term top at 120. We're back down last time I checked at 117. I think we just broke this morning 117. And if Rain is right and we are seeing maybe another wave of sell-off, I don't know, I'm on that camp as well, but maybe we are too many and maybe the pain train is still higher. But I think US dollar will strengthen, and that will be positive from European markets. However, as I said, I think the European markets in general are better able now to cope with a stronger euro, as long as we don't go to 125 or 130 in a short space. That's usually what worries the ECB. But if it comes, I think there will be dovish talk, and they'll talk down the euro, and that appreciation in itself will then contain the seeds of the new depreciation, as it will impact negatively the European exporters, obviously.
Thanks for that, Nuno. Which leads me to another topic. Our panel is called Opportunities in Europe, but we obviously have also challenges and structural challenges. Hard Brexit revisited is another, I would say, talking point. We are in the midst of this divorce between the UK and the European Union. Obviously, the UK formally left the EU in January this year, but there is still the chance of a no deal by the end of this transition period, December 2020. And NoDeal Brexit is still in the cards. Plus, the UK is also in a critical, I would say, state when it comes to the virus surge, with concerns growing for another lockdown. What investment implications do you see from this, talking about potential no deal, hard Brexit, and also coupled with the current COVID-19 situation for UK, let's say, equity and credit markets? Maybe this time we start with Nuno first answering this question.
On Brexit, I'm obviously biased, as I'm a Portuguese living in London for the last 5 years. So I'm obviously a Remainer, and I would love that UK would have stayed in the European Union, but that's done. That's no longer a matter of discussion. But also, a couple of years ago, I talked to some really smart friends in finance who opened my eyes to how bullish it can be for the UK in a medium to long term, going out of the European Union, as hard as it is for me to say that. There's a lot of red tape, a lot of bureaucracy in Brussels. We know that and not even going into the political way of how the decisions are taken, if they are more or less democratic. Let's just say we know London is a great place for not only finance, many industries, venture capital, arts, music, you name it. And I think it will continue to do so. And I think 5-10 years down the road, the UK might be maybe in a better place than it is now. It's quite a strong call to make. I think 2 or 3 years of pain is unavoidable, and we are seeing that now. But it's already priced in the equity market. So I assume I stopped following the news regarding Brexit. It's just too much for me. It's like our Brexit transition period. I love to read about politics and macro, but I have my limits, and my brain doesn't cope with so much information and change of information. Having said that, I see the UK market as a very interesting market, especially in the small mid-cap space. I see amazing opportunities there. Of course, I'm not a bottom-up guy. I don't know the companies well, but the UK managers I've seen and I've met even recently, they say it's the best opportunity they've seen in their life. Of course, their value, we all talk value is we'll need a catalyst. Maybe the catalyst will be less uncertainty regarding Brexit. We know the markets hate uncertainty. So once we have a transition period, hard Brexit, whatever, at least companies will, be able to predict for the next maybe 1 year or 2 years. I think 5-year plans no longer make sense, as we don't know what will happen in 3 years in 3 months, or after December. Having said that, the exporters, if the pound goes down, the exporters will benefit. That's more the FTSE 100, but I think it's in the AIM or FTSE 250. There are amazing opportunities right now. And also the pound looks interesting to me from a long-term perspective. It's cheap, and I think it makes sense for every investor to have 5-10% of their portfolio in the British pound, in pound sterling, because I think it's not sustainable for an economy with the characteristics of the UK economy to have a currency so weak. Let's say in 5 or 10 years, even if it can go weaker, but that will again sow the seeds of maybe a stronger recovery after a harsh period we are almost certainly to see in the next few months or years at least.
Optimistic words, looking at with a positive lens on a potential no-deal hard Brexit. Now, Ren, over to you. You as a fixed income rate specialist, what's your opinion?
Yeah, first of all, I like Luno's optimism for sure. I mean, from my perspective, Brexit will get done at some point. We're in this transition period that will end on the 31st of December, and after that, the UK will officially drop out of the EU single market and the customs union. So if there is no deal by then, trade would fall back on basic WTO rules, which is the most feared scenario, which was the worst case scenarios that we were predicting. But even if there is a deal, it will be likely on the lines of what we were calling hard Brexit 2-3 years ago. So not going to be a huge amount better. Changes for businesses trading with the EU will be immense. There'll be a considerable amount of paperwork that will cost us billions of pounds. Now, what's been going on the last few weeks is that what Johnson has done with this internal market bill is reopen all the Brexit issues, like the prospect of a hard border in Ireland, while at the same time negotiating the trade deal. So the EU has threatened with sanctions, and the odds of no deal have increased in terms of market pricing, etc. We have seen decompression in UK credit. The currency also took a strong hit. And if we don't see any progression in negotiations over the next few days, we can see more of that. But then again, here, the expectation that the Bank of England will ramp up purchases will probably put a cap on spreads again. I personally think we will get a resolution. We will get a thin free trade agreement, and trade talks might possibly continue over the longer term. And if and when that happens, sterling and UK assets can do well initially. So I'm not as bullish as Nuno, but I think initially, definitely this, the uncertainty will be gone, etc. And possibly this will take tension out of the sterling, the currency, and the UK assets in general. But in the meantime, this whole uncertainty will weigh on the UK economy. And if you think furlough rolls off in October too, or get reduced, etc., more targeted, and we go back to stricter lockdown measures, I think the next few months could be very bumpy for UK markets.
Thank you, Ren.
I just said, sorry, that I fully agree with Rain. I'm trying to look beyond this period of pain that is surely coming. I would just add that is in no one's interest to have no deal or a hard Brexit. So I think maybe we'll get a European style last minute decision on some kind of agreement of transition period, because I think, again, it's in no one's interest that we have a no deal or hard Brexit. So I think hopefully things will pan out less bad than some headlines say. But I surely do agree that we'll up for a period of pain in the next few months at least.
That makes sense. European style last minute deal, but potentially some Brexit stress until we get there. So, and another topic which is not only relevant for Europe, but it's a global theme, is sustainable investing. I would say ESG, environmental, social governance, also very important thematic and theme for us as a company at LGT. And you see also in Europe, especially the Nordic countries have been quite early and have been accelerating this type of ESG and sustainable investing theme. We see also currently with Europe's recovery plans, and you touched on this in the beginning in your comments, that there is billions of packages put together for green projects. We see that this environmental fiscal spending happening in Europe. We have Germany with 50 billion euros ready, and France 30 billion euros ready, and additional countries to follow for so-called green projects. With all of this on the agenda, I'm wondering what your thoughts are, or how you prepare for investments in ESG-related topics, infrastructure, construction. There are many themes you can basically implement this and allocate capital. I'd like to start this time with Ren. What's your opinion in terms of these fiscal spending measures and sustainable investing in Europe?
First of all, these fiscal measures, if they spend even a part of it on sustainable growth, etc., that would be already amazing if they manage to. But from my perspective, ESG has been one of the key investment themes for credit markets. That there is no denying about that. It has truly become a structural part of our investment process. And I think the pandemic has reinforced ESG awareness and demands from governments to use their policy stimulus to transform economies towards a more sustainable model. Markets have certainly bought into this. We have seen a pickup in green bond supply from both corporates and governments, which met high demand. Germany issued a green bond this month and is expecting to issue a full green curve. So I think the recent stream of inflow into ESG funds demonstrates continued investment appetite, which will by itself trigger more supply. More asset managers are launching ESG funds now. So those who already have ones are launching ones. And the inflow into passive ESG ETFs also highlights the huge potential for continued growth of that asset class.
I also would like to add our opinion, because ESG, sustainable investing and impact investing, is very important for us at LGT. We basically, in terms of liquid markets, listed securities, we built our own ESG cockpit, how we can screen and rate underlying companies and associate them with an ESG score. That's important for our direct discretionary PMs, the equity teams. So we run sustainable equity funds. And that is quite an important tool to screen. And then obviously in terms of private markets, I think there is also very interesting opportunities. You mentioned this also, Ren, when it comes to infrastructure. So there we clearly see also ways how you can allocate and be involved in what is probably a very important and relevant trend. Over to you, Nuno. Any views from your side in terms of sustainable investing, especially when it comes to Europe?
I totally agree with what you, Roger, and Drain, both of you said. It's a trend that is, I think, only just beginning. There will be more and more funds and ETFs that will screen out and leave out companies that are non-ESG compliant according to their screening process. Putting my hat of a contrarian investor, I think for less constrained investors, at some point that will open up huge opportunities in the energy and material space. We've seen recently the rally in coal companies in the US. Energy is now, I don't know, 3-4%. The number keeps going lower of the S&P. At some point, there will be value in those assets. We've seen companies like BP and Royal Dutch Shell assuming like zero carbon or aiming to be neutral carbon emissions by 2050. So they're also adapting and shifting toward renewable energy. But I would say for less constrained investors, there will be an opportunity there. There should be an extra return, as so many investors can't hold these assets. There should be an extra return for the ones who can, in 5-10 years. Maybe this is not politically correct to say, but looking just at the returns perspective, on a returns perspective, and not so much in what is obviously very important as the sustainability and climate change and all of that. I see opportunities as the energy sector and again material sector are totally forgotten and totally out of the radar of so many investors that simply can't hold those assets.
Great, thank you very much. So we are actually approaching the time limit of our panel discussion opportunities in Europe. I would like to thank you both, Ren and Nuno, very much for your participation and sharing your thoughts and investment opinions. And with this, I would like to hand over again to the conference organizer. Thank you very much.
Thank you.
Thank you.